This is Nick here, and I'm about to go through the updated U.S. business cycle chart book. So starting here with the LEI index year-over-year rate of change. It's currently at 6.4%, which is staying at an elevated level in terms of that rate of change of the underlying index. The underlying index continues to make successive new cycle highs, which is also a positive sign. So the year-over-year rate of change at 6.4% looks very strong, and generally the framework here is to be looking for this to go negative on a year-over-year basis prior to the next recession. Then turning to yield curve steepness, so this is the 10-year yield minus the 3-year yield. That's steepened quite a bit over the past month or so. It's been a bear steepening. Bear meaning bearish for bonds. Higher yields means lower bond prices. And so we've had both the 3-year yield and the 10-year yield moving higher, but the 10-year yield moving higher to a greater degree than the 3-year yield, and therefore you get this steepening, this increase in the spread, in other words. And so that's what we're observing here with this uptick. This is a monthly series, so you see this uptick here over the past month. The general trend here does seem to be continuing on a path that looks like the yield curve might invert either later this year or early next year. Of course, that could change, but it has. This is of course going to have a little bit of up and down noise, but this overall trend has been fairly consistent, and so I would, even given this backup here in the spread, I would still be looking for this yield curve to invert probably sometime in the early part of next year. Then turning to the PMIs, so the last month we had a new cycle high in the manufacturing PMI. That ticked down a little bit from 61.3 to 59.8, but 59.8 is still a very strong reading, still very close to multi-decade highs. And then the gray line is the services, or in other words, non-manufacturing. That terminology is interchangeable for this series, but that reading came in at 61.6, so that's the strongest for the cycle, and I think the strongest going back to the 90s. So that's a very positive picture in general on the U.S. PMIs for both manufacturing and services. Then looking at the global PMIs, so it is noteworthy that we've seen a little bit of a divergence here between what's going on with the rest of the world and what's going on with the U.S., and that's also consistent with what we've seen in terms of equity markets, with the U.S. equity market continuing to do generally very well versus the rest of the developed world. Here we pretty much have the largest 12 economies or so for both developed and emerging markets, and all of them are at or above 50. So Russia here coming back to the 50 level, which is the dividing line between expansion and contraction. We also have Italy right at 50 right now. So a mixed picture in terms of the developments between this month and last month, but from an absolute standpoint, all are at or above 50, which is in expansionary territory. Then turning to the labor market, so the U3 unemployment rate that came out with last Friday's jobs report, so that ticked down 0.2 from 3.9 to 3.7. That was a greater decline than what was expected. It was expected to go from 3.9 to 3.8. It's come down to 3.7, so that's certainly a new cycle low, and a new low going back to the late 1960s. The framework here is to watch for a crossover between the U3 rate, which is the black line, and its 12-month moving average, which is the gray line. So we've created more distance with this latest jobs report, so that's overall a very positive picture for the labor market. And then the San Francisco Fed model for the U3, which is the gray line here, which does a pretty good job of anticipating developments in the U3 unemployment rate, suggests that we should continue to see further declines in this unemployment rate. So that picture also looks positive in terms of the outlook for the unemployment rate. Then turning to a couple of indicators that are more negative, that are longer-term indicators. So here we have the U.S. labor market capacity utilization, which basically compares what the Congressional Budget Office, the CBO, estimates as the natural rate of unemployment versus the actual current unemployment rate. And the CBO estimate is 4.62% as the natural rate of unemployment. The actual reading, as we just noted, 3.7%, so that's a spread of 0.92%. So that's here. That suggests that that the economy might be operating above capacity, which by definition is unsustainable. But we don't know how good this, how good this estimate from the CBO is. I mean, the natural rate of unemployment might be lower than the estimate, which is 4.62. Maybe it's 3.62, in which case we wouldn't be operating above capacity. So there's certainly uncertainty regarding these estimates, and you can see back here in the 60s that this persisted for many years. So it's only one more data point that's worth cross-referencing, but it looks like this could be a typical late cycle indicator. And then very similar framework with the GDP output gap. So there's an estimate from the Congressional Budget Office, again, on potential GDP, and then a comparison to actual GDP. And there we have, we note that actual GDP is above potential GDP as estimated by the CBO. And there again, that has been a late cycle indicator in the past, and very well may signal that we're in the late cycle now. So both of these indicators, I would say, increase the recession risk over the kind of 1 to 5 year forward-looking time horizon. Then the Atlanta Fed has a GDP now, GDP forecast. That's in gray here, the latest reading at 4.1% for Q3. We have the final reading for Q2 that remained at 4.2%, so a very strong Q2 GDP growth reading. And if this indicator is any guideline, then the Q3 number when it comes out should be right around 4%, give or take a little bit as well, and that would be another strong GDP reading for Q3. Then the household credit cycle. So this is the quarterly data series from the New York Fed. We got a very positive reading on this for the Q2 update. We'll get the Q3 number in late November, but it's worth noting that we're making cycle lows on the percent of household debt that is delinquent, which is a good indicator of the healthiness of household balance sheets. Then consumer confidence. So the Conference Board consumer confidence number continues to make new cycle highs, and is generally trending higher on a year-over-year basis. The University of Michigan consumer sentiment is not making new cycle highs, but it is still trending higher on a year-over-year basis. So both of these, in terms of the near-term interpretation, is positive. But as I note in my write-up, at elevated levels, this can act as somewhat of a contrarian indicator over the medium term. You can see that we're basically back at levels that we haven't seen since basically the analog would be the very late 1990s here. That's just one data point, but we're obviously getting to some pretty elevated levels in terms of consumer confidence. Then the bank lending standards. So this is from the Fed's Senior Loan Officer Opinion Survey. So banks continue to ease lending standards, which is generally supportive of the economy. That's a quarterly series as well, but that still looks very positive. What I would be looking for there to get neutral or negative on this picture is to see the banks start to tighten lending conditions or lending standards. Then high yield spread, similarly showing a pretty positive picture here. This yield spread has been, which is the basis or the percentage point spread between high yield interest rates and U.S. Treasury interest rates, which is without credit risk. That spread has remained very contained between 375 and 290. Currently, we're right well within that range, on the lower end of that range, even at 3.18. So that all looks supportive of the outlook. It's often thought that the credit markets deteriorate before the equity markets, and we haven't seen that deterioration yet in the credit markets. Then I've got my checklist summary here. So overall, mostly positive, negative on some of these medium to longer term indicators, and kind of neutral on the. I mean, the U.S. consumer readings look so positive. It's positive near term, but I'd say it's giving me reason for caution over the medium term there, just given how elevated some of those readings are. So no change on the overall outlook on the business cycle, positive over the next few months, and neutral to negative over the kind of 1 to 5 year period, let's say. Then you can look at the PDF on the website to review the write-up there and take a closer look at some of these charts.